You don't lose money by buying bad assets. You lose money by buying good assets at the wrong time. Warren Buffett's warning today is simple: don't buy here. Confidence has a sound. It grows louder as doubt disappears. It fills conversations, headlines, and timelines. When confidence reaches that volume, it stops informing and starts persuading. People mistake the noise for truth because repetition feels like proof. What is repeated enough times begins to feel inevitable, and inevitability removes caution. When everyone around you is certain, uncertainty feels irresponsible. Silence feels like missing out. The human mind is wired to seek safety in numbers, especially when outcomes are unclear. Agreement feels like protection. Disagreement feels like risk. This instinct once kept people alive, but in modern decisions, it quietly leads them into the same mistake together. Loud confidence simplifies complex realities. It compresses nuance into slogans. This time is different. Everyone is winning. You can't lose here. These phrases remove friction from thinking. They invite action without analysis. The more they are repeated, the less thinking feels necessary. Confidence peaks when recent outcomes have been favorable. Success erases memory. Pain fades quickly. Caution fades faster. People project the immediate past into the distant future, assuming momentum is permanent. The mind prefers continuity over disruption. It feels safer to believe that what worked yesterday will work tomorrow. At peak confidence, questions feel unnecessary. Skepticism feels negative. Anyone who hesitates is labeled fearful or outdated. This social pressure suppresses independent thought. Doubt becomes socially expensive. Agreeing becomes easy. The most dangerous confidence is calm, not excited. It sounds reasonable. It uses data selectively. It points to trends, averages, and examples that support continuation. It avoids extremes and presents certainty as balance. This tone disarms resistance. It feels intelligent and safe. Loud confidence also creates urgency. If something is obviously good, waiting feels foolish. Delay becomes the enemy. Action becomes proof of intelligence. The faster the decision, the smarter it feels. This inversion rewards speed over judgment. Confidence feeds on visibility. As more people act, their actions become evidence. The crowd becomes its own justification. Seeing others commit reinforces belief. This loop accelerates until participation itself feels like validation. At this stage, price and value blur. The focus shifts from what something is worth to how others perceive it. Perception becomes reality. When perception dominates, fundamentals feel boring. Boring feels irrelevant. Attention moves away from substance and toward movement. The louder the confidence, the quieter the warning signs. Small inconsistencies are ignored. Risks are reframed as opportunities. Concerns are dismissed as temporary. Every signal is interpreted to support the existing belief. This is not ignorance. It is selective attention. People often believe they are acting independently when EY are actually responding emotionally to collective certainty. Confidence triggers fear of exclusion. The fear is subtle. It does not feel like panic. It feels like practicality. I should do this now before it's too late. The irony is that confidence is highest when future returns are lowest. When everyone believes success is guaranteed, the reward for risk disappears. Risk remains, but it is no longer compensated. People accept unfavorable terms because the outcome feels assured. Quiet periods are uncomfortable. Silence invites reflection. Reflection invites doubt. Loud confidence removes the need to reflect. It fills space with certainty, so there is no room for questions. True opportunity rarely announces itself loudly. It often appears when confidence is absent, when uncertainty dominates, when explanations are messy and incomplete. These moments feel uncomfortable because there is no consensus to hide behind. The crowd does not move because it is correct. It moves because movement itself creates reassurance. Being part of something feels safer than standing alone, even when the direction is unclear. Confidence also alters identity. People begin to associate belief with intelligence. Changing one's mind feels like admitting weakness. Commitment hardens positions. The cost of reversal grows over time, not financially at first, but emotionally. Once identity is attached, evidence loses power. Facts are filtered through belief rather than belief adjusted to facts. This is when confidence becomes fragile. It must be defended rather than examined. The loudest confid, and so often precedes the quietest realizations. When expectations are high, reality has more room to disappoint. When disappointment arrives, it does so unevenly. Some notice early, others deny longer. The silence that follows is heavy. Patience feels invisible during confident periods. Waiting produces no immediate reward. It offers no social validation. Yet patience preserves optionality. It key. PS decisions reversible. It allows observation while others commit. Choosing not to act when confidence is loud feels counterintuitive. It feels like doing nothing while others move forward. But restraint is not inactivity. It is a decision to protect clarity. Confidence demands participation. Discipline allows distance. Distance restores perspective. From perspective, patterns become visible. Hat looked like momentum begins to resemble crowd behavior. What felt inevitable begins to look conditional. The danger is not confidence itself. Confidence is useful when grounded in reality. The danger is unexamined confidence amplified by repetition and agreement. When belief spreads faster than understanding, risk hides behind comfort. The quiet observer is often mistaken for indecisive. In reality, they are preserving the ability to act later when noise fades and information becomes clearer. Acting later is not the same as missing out. It is often the only way to avoid paying the highest price. When confidence is loudest, the cost of being wrong is distributed across many people. This makes mistakes feel less personal at first. Responsibility diffuses, but outcomes do not diffuse. They arrive individually. The moment of decision matters less than the conditions surrounding it. Loud confidence distorts those conditions. It changes how risks are perceived and how rewards are imagined. Recognizing the sound of confidence is not about resisting others. It is about protecting one's own judgment. The most valuable skill in these moments is not prediction, but restraint. The ABI, ability to remain calm while others rush, the ability to wait without needing confirmation, the ability to tolerate being early or late rather than wrong. When the noise eventually fades, clarity returns, prices settle, narratives change. What once felt obvious becomes questionable. Those who waited are no longer tempted by urgency. They see options instead of pressure. Confidence will rise again. It always does. The cycle repeats because memory is short and emotion is powerful. The lesson is not to avoid confidence forever, but to recognize when its volume replaces its substance, and to understand that the loudest moments are rarely the safest places to stand. Price is the most visible part of any decision, but it is rarely the most important. It flashes, updates, moves, and demands attenti. Value stays quiet. It does not change minute by minute. It cannot be refreshed. This imbalance trains people to focus on what is loud rather than what is real. Price tells you what others are willing to pay right now. Value tells you what something is actually worth over time. The two are related, but they are not the same. Confusing them feels harmless in the moment because the gap between hem is invisible. That gap only reveals itself later when expectations meet reality. As prices rise, confidence follows. Rising numbers feel like confirmation. People assume movement implies improvement. The mind links upward motion with progress, even when nothing fundamental has changed. This association is powerful because it feels logical, but it is emotional at its core. Value is built from substance, cash flow, durability, usefulness, resilience. These qualities change slowly. They require patience to observe and effort to understand. Price reacts instantly to stories, moods, and momentum. Because price is easy to see and value is hard to measure, attention shifts toward the former. When price and value move together, decisions feel easy, But when price runs ahead of value, disco, M-fort appears. That discomfort is often ignored because it interrupts excitement. Excitement rewards participation. Doubt feels like hesitation. The separation between price and value does not happen suddenly. It stretches gradually. Each small increase feels justified by the last one. The gap widens quietly, without alarm. By the time it is obvious, it is already large. People often assume that. Higher price means higher quality. This shortcut saves mental effort. It works in some areas of life, but it fails when emotion dominates markets. In those moments, price reflects desire more than worth. Stories play a critical role in this separation. A good story fills the gap between price and value. It explains why something expensive is still reasonable. It reframes risk as opportunity. As the story holds attention, scrutiny fades. The danger is not believing the story. The danger is letting the story replace measurement. When narrative substitutes for analysis, decisions become fragile. They depend on continued belief rather than underlying strength. Value does not need excitement to exist. It survives boredom. Price often depends on attention. When attention moves elsewhere, price adjusts quickly. Value adjusts slowly, if at all. Many people say they care about value, but their behavior reveals otherwise. They check prices constantly. They react to movement. They feel good when numbers rise and anxious when they fall. This emotional response shows where focus truly lies. The separation becomes most extreme when recent success dominates memory. If something has one up consistently, the mind assumes it deserves to be higher. Deserving replaces assessing. Momentum replaces evaluation. At this point, the question shifts from what is this worth to how much higher can it go? This is a critical transition. It signals that price has taken control of thinking. Value has been sidelined. When price leads, risk hides. The upside feels visible, the downside fey. ELS theoretical. People imagine gains vividly and losses vaguely. This asymmetry distorts judgment. Value-based thinking feels slow during these moments. It does not provide quick answers. It often says not yet or not at this level. These responses feel unsatisfying when price action suggests opportunity. The cost of ignoring value is not immediate loss. It is vulnerability. Decisions made without margin leave no room for error. Any disappointment becomes painful because expectations were built on price, not substance. The separation also affects patience. When price rises quickly, waiting feels costly. People feel pressure to act before it is too late. This urgency is artificial. It exists because price movement creates fear of missing out. Value creates patience because it anchors expectations. When value is clear, price fluctuations feel less threatening. Without value, every movement feels meaningful. The irony is that the best decisions often feel boring at the time they are made. They lack excitement because price has not yet separated dramatically from value. These moments attract little attention. They feel ordinary, the MOS. Dangerous decisions feel exciting. They are accompanied by certainty, speed, and social reinforcement. These are signals of price dominance, not value clarity. Separating price from value requires discipline because it means resisting visible information in favor of invisible fundamentals. It means trusting analysis over emotion. It means accepting that being early or late is preferable to being wrong. This discipline is uncomfortable because it offers no immediate reward. There is no validation, no applause, only the quiet confidence of alignment. Value does not disappear when price falls. Price does not become value simply because it rises. Understanding this distinction changes how risk is perceived. Losses become lessons rather than shocks. When price falls below value, opportunity, thank you, emerges quietly. When price rises above value, danger appears politely. It does not warn loudly. It invites participation. Most people believe danger announces itself dramatically. In reality, it often arrives wrapped in optimism. The separation between price and value grows largest when belief is strongest. Reconnecting price to value requires humility. It requires admitting that the crowd see and be wrong, and that patience can be productive. It requires accepting that saying no is sometimes the smartest move. The goal is not to predict price movements. It is to avoid paying more than something is worth. This focus shifts the game from speculation to preservation. Preservation creates longevity. Longevity allows compounding. Compounding does not need constant action. It needs correct positioning. When value is respected, decisions become calmer. Emotions soften. Urgency fades. The future feels less dependent on immediate outcomes. Price will always move. Stories will always change. Confidence will rise and fall. Value remains the anchor that prevents drift. The separation between price and value is not a flaw of markets. It is a feature of human behavior. Recognizing it does not guarantee success, but ignoring it guarantees vulnerability. Those who learn to see beyond price gain the ability to wait. Those who wait preserve flexibility. Those with flexibility can act when others cannot. In the end, price is what is paid, but value is what remains. Understanding the difference is not about intelligence. It is about attention. Where attention goes, decisions follow. Where decisions follow, outcomes settle.